On June 16, 2026, the United States and Iran signed a tentative peace deal, bringing an abrupt end to a tense 15-week military conflict. Almost immediately, global shipping lanes like the Strait of Hormuz reopened to commercial transit. Within hours of the announcement, Brent crude oil prices dropped 4.8%. That set in relief in physical commodities translated directly to Wall Street, where the Dow Jones Industrial Average surged past 51,000 points to hit an all-time record high. This was a massive reversal from the peak of the crisis. Just weeks prior, the global energy shock was so severe that the Bank of Japan had to hike interest rates to a 31-year high just to contain inflationary pressure. Now, after months of geopolitical tension, the traditional physical economy had finally found solid ground. But while the traditional markets were celebrating this news, the tech sector was bleeding out on the Nasdaq. This horizontal bar chart shows the sheer scale of the sell-off hitting the foundational companies of the AI revolution. NVIDIA, AMD, Intel, and Broadcom all suffered severe single-day losses. Why are the highest growth companies on the planet crashing on the exact same day the global economy was saved? While international attention was focused on the Middle East, the AI hardware sector had inflated into an unsustainable supercycle. The immediate panic on June 16th was triggered by Broadcom. The company projected a very healthy $16 billion in third-quarter AI chip sales, but because that number missed Wall Street's sky-high expectations, the stock tanked 14%. Underneath that missed earnings call is a deeper structural problem, a zero-sum memory chip crisis. This illustrates the global semiconductor bottleneck. Manufacturers are rerouting massive volumes of raw materials to high-margin AI data centers, leaving only a trickle for consumer electronics. As that flow dries up, the trend line drops sharply, reflecting a 13% collapse in global smartphone demand. To survive its own massive growth targets, the AI hardware boom is actively starving the broader tech ecosystem. This crash doesn't mean the concept of artificial intelligence is failing. Instead, investment capital is aggressively splitting between hardware and software. On the software side, SpaceX just agreed to acquire the AI coding startup Cursor in an all-stock deal worth $60 billion. This scale visualization highlights the growing discrepancy. While AI software proves its utility, hardware valuations have become dangerously heavy. Intel, for example, is now trading at an astonishing 904 times its trailing earnings, completely dwarfing the S&P 500 average. When hardware valuations detach this far from actual physical production capabilities, the sector becomes a fragile bubble waiting for a pin. During the 15-week war, investors parked their capital in AI stocks under a specific assumption that software and algorithms were immune to physical supply chain shocks. But algorithms don't live in the ether. AI infrastructure requires vast quantities of rare earth metals, massive cooling systems, and stable global shipping routes. The internal memory chip bottleneck proved to the market that manufacturing AI hardware is just as vulnerable to physical constraints as refining oil. The illusion of an untouchable digital cloud has been shattered. The AI industry is permanently tethered to physical reality. That realization is driving the macro rotation we are seeing on Wall Street right now. With energy prices stabilizing, investors are pulling their capital out of overvalued tech stocks and redistributing it back into traditional blue-chip companies. World peace didn't kill the AI revolution. It just forced it to leave an isolated hype cycle and compete with a newly stabilized real world.